So we got the dollar going higher and higher and higher. It broke a critical threshold today. Let's get into what the dollar is doing, or should I say the dollar wrecking ball. Let's go right over to the DXY. This critical threshold that I pointed out, 110. So right now we're at 109.82. But as you can see throughout the day, we were over 110. So now let's go back and compare this to, let's see if we can look at a 3-year chart. So we are getting very close to the 3-year high. That was right around 113. So we're at, we crossed 105, we've crossed 110. Now, if we go up to 115, we're getting really close to 120. And personally, at 120, I think things, they might even start to break before then. Now, maybe it won't get up that high. Maybe it'll go back down to 105, take a breather, sell off a little bit. I mean, I'm sure it's overbought. And then we start to see the climb go back up close to, or maybe exceeding 120. Nothing goes up in a straight line. So we'll have to pay very close attention to this. So why? Well, you guys know from watching my videos, it's all about what this does to international economies, and therefore the global economy, therefore the global monetary system, therefore liquidity within the banking system itself. So let me give you an example of what I'm referring to here. We're going to go over to Bloomberg, and the Bank of Indonesia pledges rupiah, I believe that's their currency, defense after hot U.S. jobs number. So it's not really after hot jobs number. It's after the dollar it starts going towards 110. I mean, you could say the hot jobs number had to do with the increase in the dollar because long-term interest rates went up. And short-term, I think that affects it. We're looking at interest rate differentials. But longer-term, I think the fundamental drivers as to what's keeping the dollar above 105, and not just keeping it above 105, but having it continually go higher, getting close to where we saw it as far as its all-time high over the last 3 years, and then maybe exceeding that. I think it's really more so about the lack of liquidity, the lack of banks wanting to play ball globally, the lack of dollar liquidity, and a flight to safety at the end of the day. And even if the United States economy is doing well, even if that's your belief or your view, that's fine. But you've got to look at the rest of the global economies, the global developed economies, and they are doing extremely poorly. No one is going to debate that. I don't care how bullish you are in the United States. If I ask you how China's doing, you're going to admit that it's doing horribly. If I ask you about Germany, the UK, Canada, New Zealand, etc., or in this case, Indonesia or India, you're going to say those economies are contracting at the very least, regardless of what your view on the United States. And therefore, that's going to play into global liquidity because that means Eurodollar banks risk off. That means they're creating fewer dollars. More loans are being paid off than created. And then on net, that means supply of dollars goes down. That means the price or value of the dollar relative to other fiat currencies goes up. That means your dollar-denominated debt becomes more burdensome. And the input costs for the stuff you need, such as oil, such as commodities like wheat, like soft commodities, food, that matters, right? Those become more expensive in your local currency. Okay, so you guys get it because I talk about that all the time. But now let's see how important this is. It's not just George Gammon saying this on the Rebel Capitalist channel or on a whiteboard video. You can see it in the actions these central banks are taking. If the dollar wasn't a big deal going to 110 or higher, you would not see the central banks freaking out like this and taking extreme measures. Key talking points. Their currency fell as much as 0.6% against the greenback on Monday. That's a big move. Bank of Indonesia has promised to boldly guard its currency. Again, why? Why? It should just be a cross rate, right? Who cares if the dollar's at 110 versus 100 versus 90? I'm talking about the DXY, but who cares if the rupee or rupiah is falling against the dollar? Like, what difference does it make? Why should they care? Obviously they do. And it's because of what we were talking about earlier, dollar denominated debt and input costs. And by the way, input costs, meaning food, if we have food insecurity, what does that do for the government? The more food insecurity, the more government political insecurity you have as well, because that's where people really draw the line. Once they can't put food on the table or a roof over their head, they go to the streets with the torches and pitchforks. And a dollar is a big component of that. Politicians, central banks, they understand this very well. Getting back to the article, the central bank continues to guard its currency stability. Now, by the way, how often does this work? Rarely ever. They try to, and ask Japan, right? They came out, what was it? I think we were at 150 or getting close to 160, and they came out and defended the currency, and it dropped all the way down to 150 or 140. Now, where are we? Let's just go over to CNBC really quick and see, just out of curiosity. So we go over to FX. We're at 157. Pretty much exactly, if my memory serves me right, where they intervened initially, let's just say, what was that 6 months ago? And sure, temporarily that moves the needle, but then market forces take over and the currency goes right where it would have gone without the interventions to begin with. At the end of the day, it doesn't, you can say it 15 different ways, and whatever can happen short term, it's just noise. At the end of the day, the market can completely overwhelm any central bank, including the Federal Reserve. Let's get back to that article. So here you can see that it's getting to this dangerous level that it got to back in July. I'm sure they had some fallout from that, which is why once it's got to this level again, they're hitting the panic button. So they're saying that the blowout in U.S. non-farm payroll, okay, not really. That we're looking at interest rates along the curve. That's giving the short-term interest rate differential. That's what's hammering emerging market currencies. But it's not just emerging market currencies. I mean, let's be honest, it's hammering the euro. It's hammering everything. Here's a quote. We are in the market to ensure the balance of foreign exchange supply and demand to maintain market confidence. Good luck with that one, my friend. Sounds like a central banker. The central bank is set to announce its policy rate. The only thing that would be worse right now for the Indonesian central bank is if they came out, excuse me, and started blaming this on speculators. Once they start blaming things on speculators, you know they're done. Like, they're done. You can time these things very easily. As soon as you hear those words, you know that they are toast. It's just a matter of time. Let's get it back to this here. The dollar has had a strong start to the year as traders reassess the pace of Federal Reserve rate cuts and weigh up the likely impact of tariffs. Look, there's so many things that go into the dollar cross rate. I mean, there's literally millions of variables, but I do believe that the expectations for tariffs, higher for longer, long end of the curve going up, I think these all play into it. But I think, though, that short-term noise, I think the signal is really lack of dollar liquidity, risk off, and global contraction, well, global economic contraction. Okay, so now let's get over to kind of the mainstream view here. And for that, I like to go to Yahoo because that's kind of who they cater to, is just the mainstream retail investor. Let's see what they're saying about this dollar move. They say U.S. dollar has surged into the new year. Its rapid rise could test corporate earnings with big bank retailers. So obviously this is a more U.S. centric type of view, which is again, I think they're off sides here, because even if you are looking at this as an American, how does it impact the U.S.? You've got to start with global dollar liquidity. You can't start with, oh, what does this do to American manufacturers because the dollar is going up, making them less competitive? I mean, yeah, that's a part of it, but you're missing the forest for the trees right there, my friend. Getting back to it, this increase in dispersion of earnings per share. Okay, so this is how they're looking at it. They're saying stronger dollar is likely to add to a recurring phenomenon into earnings season. Punchline here, higher dollar is going to put downward pressure on corporate profits because it makes their products less desirable on a global scale because they become more expensive relative to the competitors. Getting back to the article, in other words, a strong U.S. dollar will adversely impact companies that do most of their business overseas, like consumer goods and household products, as it will lead to slower earnings growth over time. This typically drives a wider range of performance outcomes across index during reporting season. Okay, so this guy Wilson, he's just talking about it through, and again, I don't think that's the big story. I think that's a sub-component, but I don't think that's what we should really be focusing on, even if you're an American investor, because the global liquidity dwarfs whatever happens with corporate earnings. Because trust me, you turn off that global dollar liquidity tap, and I can assure you, corporate earnings are going to plummet, even if the dollar is going down, making their goods and services more attractive relative to other of their competitors who are selling things in currencies where their expenses are denominated in things like the British pound, Canadian dollar, Swedish krona, etc. Okay, so after hitting a September low, the US dollar index, which measures dollar value, and dollar, did they not even include the euro? Come on, Yahoo. Look at this. Am I reading this right? After hitting a September low, the US dollar index, which measures the dollar's value relative to a basket of 6 foreign currencies. Oh, okay. Yeah, I'm sorry. Sorry there. I didn't see the euro because I didn't have it capitalized. So my eye just glanced right over it. Okay. It's like 53% euro. That's why I was saying that. So bottom line is dollar is ripping higher against all of these major currencies. And Trump's proposed policies. Here's another kind of economic fallacy, in my view. They think that the higher tariffs will lead to a stronger dollar. Why is that? Because they think that the higher tariffs are going to decrease the trade deficit. And therefore, if there's a lower trade deficit, then fewer dollars will be leaving the United States, and then less supply of dollars outside the US, and what that means to the banking system, lower dollar liquidity. This, I don't think, really holds any weight. Why? I mean, just look at trade deficits and then see if you can find some correlation with the dollar. This goes all the way back to the 80s. In the 80s, there was this view that the twin deficits, I'm sure you've heard that many times, and that would be the budget deficit and the trade deficit, really impact the value of the dollar relative to other currencies. That was back in the 80s when we didn't have as much information. Now we've got a lot of data over the last, let's just say 20, 30 years that completely disproves that. That shows that there's really no correlation whatsoever. Why is that? Because these Eurodollar banks can create as much dollar liquidity as they want. They don't need dollars from the United States to create their own dollars. Now, just because they can create dollar liquidity doesn't mean they will create dollar liquidity. So what does it have? What's a much, much, much bigger component, or what's a much, much bigger driver of dollar liquidity than dollars just leaving the United States? It's risk. Because if risk is low, it doesn't matter how many dollars are leaving or coming, from the United States. There's going to be plenty of dollar liquidity because, again, those Eurodollar banks can create it on their own. But if risk is high, it doesn't matter how many dollars are leaving. You're going to have a liquidity problem because no matter how many dollars are leaving through the trade deficit, it's not really going to move the needle as far as the global monetary system. I mean, it's just math, right? I mean, at the end of the day, let's just say that our trade deficit goes from $1 trillion a year down to 500 billion. Okay, we're talking about a $500 billion difference in a global economy that's 130 trillion. And by the way, 75, 80 trillion of that is denominated in dollars. So that's, you see what I'm saying? It's like pissing in the ocean and thinking that you're actually making a big difference there. No, actually you're not. So whether you pee or you don't pee in the ocean doesn't care. So that's basically what we're looking at. And that's why you don't really see a correlation between the trade deficit and the dollar relative to other currencies. It's the size and it's the fact that these banks can create as much dollar liquidity as they want, regardless of how many dollars are coming or going from the US. It all revolves around risk. All right, getting back to it. Looking ahead, the critical questions are: to what extent these moves will be validated by incoming data? Okay, then they just go back to this nonsense about, this impacting U.S. corporations. This is very similar to the view that the mortgage crisis is what caused the GFC. It's like, not really. That was a little teeny weeny component of it. That might have been the straw that broke the camel's back. But again, that is missing the forest for the trees.